Hello and welcome to another live trading session. Today is September the 3rd, and we are getting ready to roll our lonely little put. Our new strategy is a simplified version of what we've been doing, obviously with some other differences, but one of them is that there are not many puts to take care of, not many things to work on. We do have some put debit spreads from the previous strategy that are left on, but for the strategy here, we're only talking about one put and potentially putting on another one that we're going to take a look at, given that the market is down roughly around 1.5%. And this is good. This is what we look for in order to be able to put on a second put on, but it might be still too early. So we'll take a look at that. We'll talk about that. But let's take a look here quickly at this thing right here, September 3rd. Remember, we put this one on 4 days ago. There was a weekend, bank holiday weekend, so we must have been Friday, and it's expiring today. We're going for short duration on this first naked put of the first of the sequence of the three-step process, if you will, and just keep in mind, we are not selling this put. We're not lowering this strike. We're waiting for the market. We're approaching this a little bit more with a long-term investor mind. So it's more of an active investing or a passive trading, if you will. But we are not gonna let this close at a loss. So we might be carrying on a temporary loss at some point for a little while. But given our low notional exposure and our low leverage, we don't really care about that too much, so long as we are trading something like an S&P. I wouldn't do this on any single stock. I'm basically just doing this on S&P. I have confidence in the S&P that over time, so long as I'm not over leveraged and I can stay in the market, I know that the market will come back. Sometimes I may have to wait a little bit. Sometimes I might have to wait a little bit longer, but it will come back up. And in the meantime, we'll try to collect as much data, as much of the intrinsic premium as we can. And we're going to work around that to try and extract the most amount. We'll take a look at some things here. If you want to take a look right here, for example, on this particular put, we're down for the day 263. That's about roughly, give or take, 0.5%. And the market is down 1.5%. So normally, like on a previous strategy with the market being down 1.5%, we would probably be somewhere in the neighborhood of 1.25, maybe, roughly, depending on the VIX and whatnot, obviously. But it would be more than this. So this is why we are not concerned. We don't really care. There is no extrinsic value here, and we can just go here quickly to show this this put. If you take a look here at the extrinsic value, because the expiration day is today, there is really practically not, well, there is a little bit, it goes up and down, and the bid-ask spread is a bit wide. So we're going to try and play with that to try and squeeze the mid price or somewhere close to it. But basically, there is no extrinsic value left. And if we waited for another couple of hours, it would be very close to zero. But we're not going to do that. We're not going to try and squeeze that last penny out of it. But let's take a look at this. So 56.35, we're going to take a look at our options. And before we do that, let's take a look at this main page here again. So we set this out at the onset of the strategy. Every time we start with the put number one, we record the spot price at the time, and we pre-record our subsequent strikes going down. In this case, we started with 56.15, and at the 4% down from there, it gives us 53.90, which will round to the nearest 25. So it's going to be most likely 5,400. So 5,400 would be our next step. And what we want to do, and for that to be a little bit more clear, let's see here. this is VIX over the last a few months, but the picture is pretty similar for whatever time frame you take a look. It generally trades in the neighborhood right here, you know, somewhere under 20 or over 10, between, you know, 16, 17, doesn't matter, somewhere in this neighborhood, and then occasionally spikes up. And that spike usually, you know, well, depending where it starts from, but it goes like, in this case, it would go maybe, you know, around 20 or something, and then it would go down. And that happens most of the time. Here it would go, because we started higher, it would go from 20 to maybe 30 something, then it would go down. Every now and then we get a killer right here, but that's besides the point. What's important here is that we are trying to catch a little bit of extra premium with this second put 4% down when the market spikes. So we don't want to, we have a limited ammunition. We only have, in our case, given our account size and the ticker that we use, we only have 2 shots. So one at 4%, one at 10%. So we do want to catch some of these, but we don't want to act too early. For example, when it jumps a little bit and then leave too much money on the table. And obviously, it's not exact science. We don't know how high the VIX is going to go, but we're going to try and use some estimation for that. So we'll see what the premium we can get. But the overarching goal is to ride along with one put, ride along in the most environments and wait for the little spike and the market pullback and fire another put to collect this extra premium that's available at that time. And then we basically repeat the process. We roll those puts either up or down. So if it's up, obviously the value is going to go out and we're going to close them for profit. And if it goes down, we're still in good shape. We are somewhere around 1.25 notional exposure. Nothing big. We can take a big downturn or big VIX spike. And then if we get a larger spike after that second one, like maybe something going to 30, 35 or something, then if this 10% down strike right here, like 50, if that one becomes profitable, we go ahead and sell that one. Then we have 3 of them, our shots are fired, and then we just try and collect that, wait until the theta bleeds out and potentially start defending if the market continues to go down. But oftentimes, more often than not, it will not go further down. It may, but statistically, not as often as it will turn back up. So where we are with this particular one, let's take a look at right here, and let's say we're gonna roll it now because the market got down and this strike is now at a higher delta than it was before. There might be less premium available, particularly in a shorter duration. So we might have to roll the expiration a little bit higher. So we got a choice here over the next few days, 2, 3, 6 days. So this being probably Monday, and then this is Friday. Friday, and then this is Thursday. This would be the Wednesday. So Wednesday doesn't look like it's an option because we would actually have to pay. Thursday we can do Thursday, but we might as well also look at the Friday and just leave it at that because that should be enough premium to avoid any early assignments. But there's no guarantee. Obviously, once the extrinsic value goes to 0 or close to 0, there's a chance we get assigned early, which it's not a big deal. It's just a nuisance because if we get assigned, basically we're long future. We could go turn around and quickly sell the future and sell the option again at a higher DTE. It would just involve a little bit of fees for the extra trades, but it's not a big deal. It's something you want to avoid if you can, but it's not a big deal. But if we take a look at this, for example, right here, that would show that we are buying this one here at a 74 delta. That is a little bit higher than we would like, but good enough. we're again gonna start a little bit on a greedy side, just in case we can get this to close, even though I don't think so. We're gonna probably have to work our way down, but we'll do it. We'll send it as is, and then we'll take a look while we're waiting for this. We'll take a look at some other things, namely the second bullet. For the second bullet, if you remember, the strategy calls for 2 to 3 weeks out instead of short duration. The second bullet, we want to extend the duration. We are taking advantage of the increased wicks, and we want to maximize that. So we want to give a market some time. So we're gonna extend it to maybe roughly 2 to 3 weeks. This is a little bit of play by the ear type of a thing. There is no huge difference whether we go 14 days, 18 days or something. We're going to look for the premium and see what's available, and maybe liquidity at the particular DT or whatnot. And just like that, if we go to a third bullet, which is 10% under the spot price, original spot price, and if we decide to go for that one, if there's a larger spike, if the market continues to go down afterwards, then we're going to be looking for something between 4 and 6 weeks out, a little bit further out, collect as much premium as we can, because that's it. We're not going to be able to fire the third shot. And let's start with this one, 2 to 3 weeks out. So we could potentially look at the 16 days or go into the next one right here. So let's see. So somewhere between these two. So if we wanted to stay in this particular expiration, the future, we can go to 53.40 and see what we can get. No, what did I say? I'm sorry. 53.40. Is that right? No, 5400. I'm sorry. 5400. Don't mind me. 5400. So that would be right here. Now this is pure extrinsic value. This is pure theta. This strike is still way out of the money, and we're looking for extrinsic value play. And in this case, we're looking at $132, which I want to say it's still a little bit on the low side. And I don't think I want to fire this bullet yet. Now, what's the risk of not firing the bullet? The risk is that the market returns back up, and we miss this opportunity. So we have to weigh that against the other option. And I think that in this particular case, if the market turns back up, we still have a little bit of theta collection on the other one. We'll get a bunch of delta that we lost, and I think it's a borderline, but I would like to see a little bit more premium here for this second shot. Now, if we go to a second time, 17 days. No, what is it? This one's 17 days. Now. This is looking even worse here. So let me see, 24 days. And this is now a little bit farther away than I want to go. So what I'm going to do is basically nothing. I'm going to sit on my hands for a little bit longer, unless the VIX spikes later on in the day and the market drops down maybe to 2% or something. Then I'm going to just revisit this if I'm around the computer. But again, no urgency. If I don't do it, I don't do it. I missed the opportunity. I'll come in tomorrow and potentially sell it for more money. But I don't need to get too worked up about doing it exactly now. There's just not enough premium for me to be happy selling it at the moment. But so we'll leave that one as is. Let's go back to our little friend here and work our way down. And then let's just see 1450 as a mid price. Okay, let's replace this. Let's go to 15, see if that would maybe hit. No. And then replace. So Okay, let's see. Where's 56.35? Well, we're gonna go replace because we want to close this. We don't want to hang around with this for a couple of bucks. So let's do this. All right, so 14.25 is what we collected in additional premium. We're gonna go back here. We're gonna go behind this and say plus 14.25. We're gonna put 2 rolls here instead of 1, so that our commission and fees can be calculated properly. And then, so that's where we at. So overall, we collected a total credit of 265, and then we'll see if what market is going to do over the next few days. But that's it. There is not much else to do. Another thing that's pretty good about this strategy now, and the difference is it leaves a little bit more money on the table to buy T-bill or some other ETF. I have the SGOV. But before, because the way the futures work, and you need some extra cash around overnight for overnight transactions, you need to have some extra money in order to avoid borrowing inadvertently borrowing money from your broker and then paying high interest on it. So you have to stay somewhere in the neighborhood of roughly 60%, give or take, depending on how many options you have open. You have to maybe spend around 60% of your net lick on this SGOV or T-bill or similar. But with this strategy, because we only have a couple of puts and our buying power is very low, we can go very close to 100%. I'm gonna play with 90% and see if I'm paying any interest on it. I think I have a little bit of room. This is 40,000 and I have 47, so I could maybe go and buy another. Let me go and buy. Was that 50? Would that maybe let's see, how much is that gonna cost? 4,000. Yeah, so 4,400. So that's very close to, that's a little bit over 90%, and I think that's fine. We're just gonna go ahead and buy that, and I think that's a big plus for larger accounts. If you build your account up, you go to portfolio margin, and you basically can put basically all of your money, almost all of your money, into guaranteed whatever the interest rate is at the time. Right now, it's not bad. I mean, it's not always going to be that high, but I don't see them going to zero anytime soon. So this is the extra profit that could make a significant difference overall on a yearly basis or over a few years. So keep that in mind. I think that's a good thing. And is there any questions? Anyone? All right, guys. If not, I will see you, unless there is some trade in between, I will probably see you for, well, where is the Friday, September 6th. This one expires September 6th. So I will see you then. Have a fantastic rest of the day. Bye.